Hey everyone, welcome back to the Unlearned Investor. I'm so glad you're here. Quick heads up before we dive in. This might be one of the lengthier episodes of this season, but honestly, I couldn't break it into two parts. The pieces of today's conversation build directly on each other, and splitting them up would just kill the continuity. So, if you can, try to listen to this one in a single sitting. It'll make a lot more sense that way. And before anything else, the standard reminder: I am not a financial advisor. Everything you hear here is for educational purposes only. Always do your own research and speak with a certified financial professional before making any investment decisions. Alright, let's get into it. So, in our last episode, episode 5, we covered what a stock actually is: a slice of a real business with employees, products, and bills to pay. And we ended that episode with a warning: a bad business sinks your capital, and a good business bought at the wrong price disappoints you for a long, long time. Today, we are getting to the practical question: how does an ordinary person actually figure out what a business is worth? And how do you tell whether the market is giving you a fair deal on it? Let me start with a quick puzzle. Imagine two companies. Company A trades at $100 per share. Company B trades at $200 per share. Which one is cheaper? Most people instinctively answer Company A. It costs less, so it must be the better deal, right? Wrong answer. And the reason it's wrong is the foundation of everything else we are going to talk about today. The price of a single share tells you almost nothing on its own. It tells you what one slice costs. It does not tell you what you're getting for that slice. Think about it this way: a $100 share of a company that earns $1 a year in profit is wildly more expensive than a $200 share of a company that earns $20 a year in profit. The first one takes you 100 years to pay back, the second one takes 10. So, to compare prices honestly, we need a common yardstick. We'll get to that yardstick in a few minutes. But first, what are we actually trying to measure? Every business has two prices. The first one is called the market price. That's just what people are willing to pay for a slice of the company on the stock exchange today. This number moves every second. It's driven by mood, news, fear, greed, and a thousand other things that have absolutely nothing to do with the actual business. The second price is called intrinsic value, and that's what the business is genuinely worth. It's based on its earnings, its assets, its debts, and its prospects. This number moves slowly. It reflects reality, not headlines. And investing at its core is just the gap between these two numbers. When the market price falls below intrinsic value, you have an opportunity. When the market price runs far above intrinsic value, you have a trap. Most of the time, though, the two are roughly aligned, and the patient investor simply waits. Here's the thing: estimating intrinsic value is part art, part arithmetic. Nobody nails it exactly. Fortunes are made when investors get this right, and lost when they get it wrong, which is exactly why the next idea matters more than any other in this whole episode. Benjamin Graham, often called the father of value investing, the man who turned investing from speculation into a real discipline, he built his entire philosophy around three words: margin of safety. Let me explain it with a bridge. Imagine an engineer designs a bridge to carry trucks weighing 30,000 pounds. Now, would you drive a truck weighing 29,500 pounds across that bridge? Probably not. You'd drive a 10,000 pound truck across it. Why? Because the extra capacity is your protection. Protection against bad weather, hidden cracks, the simple reality that nothing in the real world performs exactly as designed. Investing works the exact same way. If you estimate that a business is worth $1,000 per share, you do not buy it at $990. You wait. You wait until it falls to 700 or 600. The gap between what you think it's worth and what you actually pay, that's your margin of safety. That gap protects you from being wrong. And let me be honest with you, you will be wrong. Sometimes spectacularly. Margin of safety is what keeps a wrong call from turning into a complete catastrophe. Okay, so to estimate intrinsic value, you need to know what's actually happening inside the business. and there are two financial documents for that. Every public company is legally required to publish them. The first one is called the balance sheet. Think of the balance sheet as a snapshot. It freezes the company in time on a single day, usually the last day of a quarter or the last day of a year. And it answers one question: what does this company own and what does it owe? On one side, you have the assets, cash, inventory, buildings, equipment. On the other side, you have the liabilities, loans, bills due, pension obligations. The difference between the two is called shareholders' equity. That's what would be left for the owners. That's you. If the company sold everything off and paid every debt tomorrow. Here's a way to remember it. A balance sheet tells you how strong the body is. It does not tell you how fast it can run. The second document is called the income statement, sometimes called the earnings statement, or the P&L. If the balance sheet is a snapshot, the income statement is a movie. It covers a stretch of time, usually a quarter or a year, and it answers a totally different question. How much money did the company bring in and spend during that period? It starts at the top with revenue. Revenue is every dollar that came in from sales. Then the company subtracts cost after cost: cost of goods sold, operating expenses, interest on debt, taxes, and what's left at the very bottom, that's net profit, fittingly known as the bottom line. So, just to recap, the balance sheet shows what the company is, the income statement shows what the company did, and you read both, always. Alright, now we can finally answer that puzzle from the start of the episode. To compare two stocks fairly, we use something called the PE ratio, P over E, price divided by earnings. But earnings of what? Earnings of one share. So, first we need a number called earnings per share, or EPS. EPS is just the company's total net profit divided by the number of shares the company has issued. It tells you how much profit each individual share earned for its owner during the year. Now divide the share price by EPS and you've got the PE ratio. The PE is the real price tag. It tells you how many years of the company's profit you're paying for upfront. A PE of 10 means you're paying $10 on the table for every $1 of annual profit. A PE of 50 means you're paying 50. So suddenly the cheaper looking stock from our puzzle, it's often the more expensive one once you actually run the math. But here's the trap, and it's a big one. There is no universal PE that's cheap or expensive. A PE of 25 is sky high for a slow moving utility company. The exact same PE of 25 is dirt cheap for a fast growing software company. The right comparison is never against some magic number, it's always against three things. 1. The same company's own historical PE. Is it priced higher than it usually trades at? 2. Other companies in the same industry. How does it stack up against direct rivals? And 3. The broader market average. Is the entire market frothy or fearful? Our PE only makes sense in context. Now, here's something seasoned investors know: earnings can be massaged, cash cannot. This is why they look beyond net profit to a third major financial document, the cash flow statement. And honestly, this might be the most truthful document of the three. The cash flow statement tracks the actual movement of money in and out of the business. Real dollars changing hands. No accounting tricks. A company can show $100 million of profit on paper while bleeding cash in real life. Maybe inventory is building up. Maybe customers aren't paying on time. Maybe aggressive accounting is masking the truth. The cash flow statement strips all of that away. So, if a company reports rising profits but falling cash flow year after year, something is wrong. That's a flashing red light no balance sheet will spell out for you. While you are looking at the financials, look at two more things. First, debt. How much does the company owe? More importantly, how much is it paying every single year just to service that debt? A business that hands half its operating profit to lenders has very little left for shareholders. Second, the expense breakdown. Look at the income statement again, but slowly this time. If a company brings in $1 billion in revenue, where does the money actually go before it reaches the bottom line? How much goes to making the product? How much goes to running the business, salaries, rent, marketing? How much goes to interest on debt? How much goes to taxes? How much actually reaches net profit? Let me put numbers on this. A company that turns $1 billion of revenue into $250 million of profit is keeping 25 cents on every single dollar. That's a healthy business. Now compare that to a company that turns $1 billion into just 15 million. That's keeping 1.5 cents. That's a struggling business, even if its absolute revenue is enormous. This brings us to one of the most underrated ideas in all of investing: pricing power. Pricing power is just the ability of a company to raise its prices without losing customers. Sounds simple, right? But it changes everything about how a business is built. Companies fall into two broad camps because of it. The first camp, let's call them the volume players. These are businesses that make money on scale. Think mass market consumer goods, soap, shampoo, biscuits, basic groceries. Their margins are thin, sometimes just a few cents per unit, but the volumes are enormous. They sell to everyone. Their entire strategy is built around acquiring more customers, more shelf space, more reach. Lose volume, and the math breaks. For a volume business, more customers always means more profit. The second camp, the premium players. These are businesses that make money on aspiration. Take a luxury house like Hermes. They could double their handbag production tomorrow and sell every single bag. They deliberately don't. And the reason is genuinely counterintuitive. If everyone could carry the bag stops being aspirational. The brand collapses. So, premium businesses walk a tightrope. Sell too many units, and the brand loses its aura. Sell too few, and the heavy marketing, the craftsmanship, the store experience costs, they eat the profit alive. Their whole strategy is built around fewer customers paying much more and protecting the exclusivity that justifies those high prices. So you see, the two camps are mirror images of each other. A volume business wants more customers. A premium business is wary of them. And here's a nice nuance: premium businesses themselves split into two flavors. Some target a small, wealthy audience with a deeply curated experience: luxury cars, private banking, designer fashion. They serve few customers, but they serve them lavishly. Others manage the rare trick of becoming aspirational at scale. Apple is the textbook example here: premium pricing, mass adoption, and a brand strong enough to keep margins healthy even as their volumes balloon. That kind of business is extraordinarily rare. When you find one priced reasonably, you take it very seriously. So, when you read a company, ask yourself which camp it lives in, then ask whether its margins make sense for that camp. A volume brand with luxury level margins is either a fraud or a future case study, and a luxury brand with volume level margins has lost its way. Here's the next principle: one number is just a number, a trend is a story. Whatever you measure, revenue, profit margin, debt, cash flow, EPS, never look at it for 1 year alone. Always pull up the last 5 to 10 years and ask one simple question: is this normal for this business? Let me give you an example. If a company's profit margin has been a steady 18% for a decade and it suddenly drops to 9% last quarter, you do not shrug it off. You investigate. Maybe a one time event distorted it, a lawsuit settlement, a write off, a bad currency move, or maybe the business is quietly breaking. The numbers won't tell you which, but the change itself is the signal that says start asking. Same goes the other way. If revenue suddenly explodes by 80% in a single quarter, that's not automatically good news either. Maybe the company sold off a division. Maybe it changed how it counts revenue. Anomalies, both good and bad, almost always have a story behind them. Your job is to find that story before you click buy. This is the work most amateurs skip. It's also the work that separates real investors from people who buy stocks because of a confident podcast host. Okay, now this next section, I want you to really pay attention to this one. All this analysis, all this reading, all these ratios, and you can still lose money on a stock. Markets get hit by recessions nobody saw coming. Companies get blindsided by regulation, technology shifts, scandals, even bad weather. A perfectly analyzed business can still disappoint you. So, if losses are unavoidable, what's the point of all this work? The point is this: the goal is not to win on every stock. The goal is to own enough good businesses that the winners more than cover the losers over a long enough time frame. Even seasoned investors get it wrong close to half the time. Half their picks lose money or go nowhere. The other half, the genuine compounders, they grow so dramatically over the years that they cover every loss and still leave a fortune behind. Real stock market wealth is not a smooth line going up. It's a messy collection of bets where the winners outweigh the losers badly given enough time. This should change how you think about your portfolio. Stop trying to pick only winners. You will not. Pick a handful of genuinely good businesses you understand. Give them years to do their work and accept that some of them will disappoint you. Time, not timing, is the real engine. But owning is not the same as ignoring. Once you're in, follow up, read the quarterly results, listen to what management says, and just as importantly, listen to what they carefully avoid saying. Watch for slow shifts in margins, in debt, in market share. The same checks you ran before buying, you keep running every single year. This is where the hardest skill of investing shows up, knowing when to act and when not to. Two scenarios will test you again and again. The first scenario: the company is breaking, margins are sliding for real reasons, management is behaving badly, the moat is shrinking, the business has fundamentally changed for the worse. That's when you sell. Even if the stock is up, bad businesses do not become good ones because you stayed loyal. The second scenario: the price is breaking, but the business is fine. Markets get scared, a geopolitical shock, a bad quarter for the entire sector, a panic that has absolutely nothing to do with this specific company. The fundamentals are intact. The story is unchanged. That's when you stay, even when everyone else is running. These dips, these moments, this is how patient investors quietly get richer than impatient ones. Read the difference correctly, and time does the rest. So, is this all there is to picking a great investment? Not quite. Let me sum up what we have so far before adding the final piece. You don't need to memorize 100 ratios, you just need to understand a handful well. Intrinsic value is what a business is genuinely worth. Margin of safety is the gap that keeps a wrong call from becoming a catastrophe. The financial statements show you what the company is, what it did, and where the cash actually went. The PE reveals price, but only when set against the right peers. And margins reveal whether a business has real pricing power. And every number always is read in context, never alone. But on top of all of this, there is one thing that overrides absolutely everything else: who runs the business, the best margins, the strongest balance sheet, the widest moat. None of it matters if the people at the top are not honest. A business run without integrity is always living on borrowed time. Sooner or later, the cracks show. Numbers get massaged, shareholders get treated like an afterthought, and the stock crashes overnight. So before you put money into any company, look at the people steering it. Read what the CEO promised in past annual letters, and then check what they actually delivered. Look at the promoters and the founding family. Do they treat shareholders as partners or as wallets to be raided? Look at how management gets paid and whether that pay actually matches the results. Numbers tell you what the business is doing today. The people tell you whether it'll still be standing 10 years from now. Okay. One final thought to chew on before we wrap up. Do you think buying shares of a business is the only way to make money in the stock market? Absolutely not. The stock market offers a whole shelf of other products, different instruments, different rules, different trade offs, and we'll get into all of them in the next episode. Quick reminder before we go: I am not a financial advisor. Everything we covered today was for educational purposes only. Always do your own research and speak with a certified financial professional before making any investment decisions. If you found this episode helpful, please follow the Unlearned Investor on Spotify. And if you'd like the full written version of today's deep dive, head over to unlearnedinvestor.substack.com. Until then, see you and take care. Signing off, the Unlearned Investor.